HDFC numbers have come out. Numbers are flashing on your screen. These are Q2 numbers of HDFC. Earnings are in line broadly with estimates. PAT is at 1270 versus 18-hour poll of 1327. So on a like-to-like basis, this is a good 40-50 crores higher than what we were penciling in. A large part of the PAT growth, to my mind, has come from the core business, because this time around the dividend income from subsidiary was expected to be low. So PAT stands at 1220 versus 18-hour poll of 1237. These are good set of numbers. These are impressive set of numbers. They may not nudge the needle much for HDFC in the short term, because this stock is broadly held by institutional investors who've been holding on to HDFC for years now. So these numbers are just some kind of an endorsement that HDFC has managed to grow in a tough environment, and for the quarter gone by, irrespective of what happened to the cost of deposits and cost of running operations, they managed to maintain their NIMs as well. PAT 1266 versus 1151, which honestly is more than a 20% growth, which is not bad.
Just awaiting the NII numbers though. Even we're expecting an uptick of about 15% or so. 1880 crore rupees is what we're expecting by way of the NII performance from HDFC for the second quarter. But just have the poll figures for you, and optically at least it looks like a good number. Still don't have any more details besides what the bottom line has delivered. But the stock has peaked out now from the low point of the day. It's trying to recover back into the green, now down by just about 6 odd points. Remember, just a short while back as we stepped into the earnings, the stock was down nearly 1.5%. Now you're seeing some bit of recovery coming in. Total income figure, no, we're just awaiting what the NII and the NIMs are like, and of course the asset quality as well. We want to see what the trend in margins and spreads are, especially in the individual book. The credit growth in the loan book is something that we would want to look out for. Okay, the NII has come in at 1814. That is a little disappointing, because we were expecting 1880 crore rupees. 1814 is what HDFC has delivered.
I think the management is...
We had the board meeting for approval of the accounts for the 6 months ended September 2013, and I thought we'd run through quickly some of the key financial numbers and then take any questions that you may have. When you look at the loan book, there has been a lot of worry in the market, and particularly in the media, about a slowdown in the economy and slowdown in growth, and demand for housing not taking place, and so on and so forth. So we are glad to report that our total loan book outstanding on 30th of September amounted to 1,84,886 crores of rupees, which represents an increase of 19% over the previous year. However, this number of 19% has been calculated after taking into account the loans that have been sold in the last 12 months. So if you see, in the last 12 months, we have sold loans aggregating to as much as 3,792 crores. If we add back these loans sold, then the growth in the loan book would be as high as 22%. Now, even though 22% is the total loan book growth, if you break down the loan book growth between the growth on retail loans, which is our core business, individual loans, and non-individual loans, you will see that the growth is largely coming on individual loans. So if you take the first 6-month period, then the growth in the loan book for individuals after selling loans was 26%. But if we add back the loans sold in the last 12 months, then the growth in the individual loan book is as high as 29%. As of 30th of September, we are today carrying a total of 16,497 crores of rupees, which is in respect of loans which we have sold, but on which we get a weighted average return of 1.29%. Now, the way this works is that we sell a lot of our loans every year, and when we sell a loan, we don't book accounting profits upfront. So, for example, if the underlying interest rate on a loan that we have sold, for argument's sake, is, let's say, 10.5%, and we have sold the loan, let's say, at, again for argument's sake, 9.25%, the customer continues to pay 10.25% to us. Of that 10.25%, we retain, in this example, 1.25% as our income, and pay the balance back to whoever we have sold the loans to. So that then creates a stream of income for future years. So on 30th of September, as I said earlier, we have 16,497 crore rupees of loans, individual loans, sold by us, but on which we are getting a weighted average return of 1.29%. As I said earlier, the growth in the loan book is largely on individual loans. So if you look at the incremental growth and break that down between individuals and non-individuals, 91% of the growth in the loan book is on individual loans and only 9% is on non-individual loans. Our spread as of September stood at 2.24%. If we break down that 2.24% between individual loans and non-individual loans, individual loans carried a spread of 1.98%, non-individual loans carried a spread of 2.76%. If you look at net interest margin for the first quarter of the year stood at 3.9%, but historically if you see for the last many years, you will see that with every quarter, the net interest margin tends to get higher and higher. And if you were to look at the 6-month period, the net interest margin number stood at 4.1% as compared to 3.9% in the first quarter of the year. Non-performing loans as of 30th of September stood at an aggregate of 0.79%, and this compares to 0.77% in June. So there is a marginal 2 basis points increase in the non-performing loan number. However, if you look at the breakdown of the non-performing loans between individual loans and non-individual loans, then individual loans has shown a further improvement from June. In June, the non-performing loan number was 0.61% for individuals. It has now come down in September to 0.59%. But there is one particular loan which we have classified as a non-performing loan in June, and there is a second loan given to that same company. This is Hirco, which is also being classified as a non-performing loan in the September quarter, and therefore we have reversed the income in respect of that entire loan. Now this is a technical default. The land is good, the property is very good, the security is very strong, but there is a dispute between the two partners who are doing this project. So we will acquire this project through a SARFAESI route and we will auction it. The auction would probably be taken up by one of the two parties who are doing this project. So the non-individual, non-performing loan number now stands at 1.19%. The overall non-performing loan number, I repeat again, stands at 0.79%. If we look at the regulatory provisioning under the NHB rules, there has been some reduction in the level of provisioning that is required. It was first introduced by RBI and was applicable to banks. It is now applicable even to housing finance companies. So as a result of that, the excess provisioning that we are carrying today on 30th of September stands enhanced to as much as 493 crores. So we carry a provision which is 493 crores higher than what we are required to carry as per regulation. The actual provisioning we carry is 1,811 crores against a regulatory requirement of 1,318 crores. Because of the provisioning change where there is a reduction in the level of provisioning that we need to make for loans given to property developers for residential housing, there is a saving of the provisioning amount to the tune of about 45 to 50 crores. So we are taking that benefit of 45 to 50 crores on a pro rata basis over the next 3 quarters. To that extent, the provisioning figure for this quarter is lower, but you need to bear in mind that we still carry after that an excess provisioning of 493 crores beyond what is required by regulation. As you are aware, we hold all our investments under Indian GAAP at historical cost and not at fair value. If we were to fair value the listed investments, let's talk only of listed investments where there is a transparent stock market valuation you could look at. The unrealized gain on those listed investments as of 30th September stood at as much as 28,938 crores of rupees. So we carry a huge amount of unrealized gain on our listed investments, which is even higher than what our shareholders' funds today are. Our book value per share number stands at 178 rupees, but if we take into account the 28,938 crores of unrealized gain, add that to shareholders' funds and then compute the book value per share number, the number would increase from 178 rupees a share to 364 rupees a share. And mind you, 364 rupees a share would not value or would not give any value to our investments in our unlisted subsidiaries. So if we were to look at life insurance, general insurance, asset management, investment, venture capital, there would be a huge amount of unrealized gain on those investments also. I'm not giving you any number because there is no transparent stock market valuation on the unlisted investments. Now, there has been a reduction when NHB made the change on the provisioning requirement, where they reduced the level of provisioning that was required. They also reduced the risk weight in respect of certain categories of loans. So because of the reduction in the risk weight, our capital adequacy would have stood enhanced to a level of as much as 19%. If we break down that 19% between Tier 1 and Tier 2, then Tier 1 capital stands at 16.5%, Tier 2 capital stands at 2.5%. But what we are also declaring from this quarter onwards is what would be the impact on capital adequacy if we were to reduce the investment in our bank from Tier 1 capital. So theoretically, if we were to reduce our investment in the bank from Tier 1 capital, then the capital adequacy number would remain at 16.1%, which is broadly in line with what the number was in the June quarter, even after reducing the investment in the bank from Tier 1 capital. Now, just to put that in perspective, all our investments in subsidiaries, which is life insurance, general insurance, asset management, venture capital, and so on and so forth, we reduced those investments from our shareholders' funds for calculating our capital adequacy. But in respect of the bank, because it is not a subsidiary, it's an associate company, we have always been treating it as a risk-weighted asset. But a lot of analysts have been asking us what would be the impact if we were to reduce the investment in the bank also from Tier 1 capital. So with the reduction in the risk weight, I'm glad to say that the capital adequacy number continues to remain a very healthy 16.1%, even if we reduce the investment in the bank from Tier 1 capital. Now, if you look at the profit for the quarter and for the 6-month period, the profit before the pure operating profit, which is profit without taking into account profit on sale of investments, without taking into account dividend, and without taking into account tax, that number grew by 16% both for the quarter and the 6-month period. So 6-monthly quarterly profit before dividend, before profit on sale of investments, before provision for tax for the quarter was 1,464 crores compared to 1,260 crores last year at this time, giving an increase of 16%. The 6 months profit calculated on a similar manner stood at 2,855 crores compared to 2,460 crores last year, giving a similar increase of 16%. But as I said in the beginning, dividend income for this year or this quarter is lower than what it was last year. The reason being that HDFC Bank had declared dividend in the first quarter of the financial year this year, whereas last year the dividend was received in the second quarter of the financial year. So because dividend income is lower and because profit on sale of investments figure is lower, the post-tax profit, if we were to look at, stands for the quarter at 1,266 crores rupees, which compares to 1,151 crores in the previous year, giving an increase of 10%. The 6-monthly profit figure stands at 2,439 crores. This is post-tax, post-profit on sale of investments, post-dividend, compared to 2,153 crores last year, giving an increase of 13%. Now, we have a number of subsidiaries, the life insurance, the general insurance, the asset management, the venture capital companies, all of which are now maturing and generating higher and higher profits every year and every quarter. So if we were to look at our consolidated profits, and when I talk of consolidated profits, I'm even reducing the charge to our share premium account in respect of zero coupon bonds. Even after reducing that, the consolidated profit after tax for the second quarter stood at 1,806 crores rupees compared to 1,455 crores last year, giving an increase of 24%. If you look at the 6-month period, the 6-month consolidated profit stands at 3,426 crores rupees compared to 2,582 crores last year at this time, giving an increase of 32%. And as we've been saying time and again, the share of profits of the subsidiaries as a proportion of the consolidated profits of HDFC keeps rising every year. And in the first 6 months of this year, the subsidiaries now account for as much as 32% of our consolidated profits, compared to only 24% in the previous year.